The topic that we are starting off with is called cash flow statement. For most of the level 1 candidates, this is generally considered as the most or one of the most difficult readings at CFA Level 1. So there are two ways of approaching this reading. One is that there are a lot of formulas given in the notes and curriculum. So all of us would run through the formulas, remember them and try to apply, which of course is not working with us. The alternate approach is we will understand what the concept is and then try to solve questions using the concept. The difficulty with this approach is to understand cash flow statement, you also have to understand income statement and balance sheet very, very well. You should be really clear about how numbers move between financial statements. So my approach for this particular reading is going to be that we will have a lot of transactions. With those transactions, we will prepare balance sheet and income statement. And then parallelly, we will see how cash flow statement is being prepared so that you would understand how the numbers are moving in different financial statements. Okay. So let's first do an example. Example number 1. Let us say we have set of transactions. Capital, a new business started, capital invested, 10,000. Bank loan taken, 20,000. Building purchased, 10,000. Sales made, 50,000. Salary expense, 5,000. So what I want you to do for the timing, just prepare an income statement and balance sheet out of these set of transactions. Can you do that? Alright, so let's do it together. Please observe. So this is your balance sheet, cash flow statement. Balance sheet and income statement. By convention, we are going to write assets on the right, liabilities on the left, but we can also write it the other way around. Expenses on the left, income on the right. Capital 10,000, so I am putting that in the balance sheet liability side. Does it have a second effect? Yes. Cash will increase, so we will say cash 10,000. Bank loan, again it would go to the balance sheet liability side. So bank loan 20,000. Second effect, now cash will increase and cash will become how much? 30,000. Then building 10,000, that would go on to balance sheet asset side. So building 10,000, what should be the second effect? Cash. So now cash would be 20. Sales 50,000 on the income side. Second effect? Cash, which is 20, now which will become 70,000. And salary expense, which is 5,000. Second effect, cash will reduce and now cash is 65. So now we would do the finalization where we will say income 50,000, salary 5,000. So profit is 45. We write profit on the expense side so that both the sides total comes out to be 50, just a balancing figure. So we would take that profit. This profit would be transferred onto the reserves as a part of equity. So reserves 45,000. And then we will take totals. So this is 75. This is 75,000. How many of you got this right originally? Great. Now we will prepare a cash flow statement for these financial statements. Now cash flow statement always tries to diagnose what are the reasons why cash is increasing or decreasing for a firm. So this is a new business. What was the amount of cash we had last year? 0. And what is the amount of cash we have this year? 65. So essentially we are trying to diagnose the difference between this, which is 65, that how is that 65 generated. And this cash flow statement or sources of cash we will divide into 3 parts. Cash flow from operations, cash flow from investments or investing activities, cash flow from financing activities. So CFO, CFI, CFF. Operations is all related to operations. So when you receive cash by sales, you receive cash by accounts receivable, you spend cash for paying salaries, purchases, all business related items will come in CFO. Investments is all about assets. So when you purchase assets, you sell assets, it's a part of CFI. And financing is typically about bank loans, it is typically about equities. So when you raise equity or when you pay back bank loan, that becomes a part of CFF. So transaction number 1, capital 10,000, is it CFO, CFI or CFF? CFF. Since it's a financing nature of activity, we will say 10,000 is a part of CFF. Then bank loan 20,000, it should be a part of CFF. So since it's a financing activity, again we will say 20,000. Building 10,000, it is a part of investing activity, CFI. But is it an inflow or outflow? It's an outflow. So we will say minus 10,000 here. Sales 50,000, it is a part of operations. So plus 50,000 in CFO. And salary, again a part of operations. So minus 5,000 here. Let's take a total of all the components. This is 45,000 minus 10,000 and 30,000. So total of all the 3 cash flows, how much? 65,000. And is it matching with the increase in cash? Yes. That means we've done this right. Are we okay with this concept? Now let's build on to this question. Let us assume that now we are in year 2. Okay, now year 2 balance sheet is going to be a carry forward balance sheet. So the first year I'm keeping it intact. Okay. So let's have a few set of transactions. Now in the second year of the business, same business, the firm, transaction number 1, decided to purchase furniture. Firm decided to purchase furniture of 30,000. Then it decided to repay the entire amount of bank loan. Then it made sales of 50,000, but 10% of sales was made on credit. And again it paid salaries of 5,000. So now I want you to prepare a balance sheet and income statement for year 2. And what you want to appreciate is when you're in year 2, you will have to build on to the balance sheet of first year. It's not a fresh balance sheet anymore. You're building it for the second year. Start. Let's do this together. So now we are in year 2. This is balance sheet, income statement. First transaction, furniture 30,000. There is nothing with respect to building. So those items where there is no transaction, you just copy paste the numbers from this side to this side. So building 10,000, I'm just reproducing it on this balance sheet. Then furniture 30,000. What should be the second effect? Cash. So your cash, which was 65,000 last year, now it will become 35,000. Then last year your capital was 10, so I'm bringing it as it is. Your reserve was 45, so I'm bringing it as it is. Bank loan was 20, but you decided to repay the bank loan. So now bank loan will become 0, but your cash will now become 15. So cash now 15,000. Then sales 50. So we have to write sales on the income side. Should I write entire 50? Yes. Using accrual system, we will write entire sales of 50 here on the income statement. But to the cash, should we add entire 50? No. How much cash we have received? 45. So cash would be 60,000. But then how about remaining 5? Accounts receivable 5,000. Then salary 5, which is an expenditure. What should be the second effect? Cash will reduce. So now cash is 55,000. And then we do the finalization. So we will calculate profit. Profit is how much? 45. So reserves of last year 45 plus this year 45. Your total reserves now would be 90,000. And then balance sheet total 100,000, 100,000. How many of you could tally this? Fine. Any part you want me to repeat out of this? So now, last year your cash was 65. Last year cash 65. This year cash is 55. The difference in these two cash components is how much? Minus 10,000. Your cash is reduced by 10,000. So the total of your three components of cash flow statement has to be minus 10,000. Cash flow statement is not about this 65, neither about 55. Cash flow statement is the amount by which your cash is changing. So let's start building cash flow statement now. Three components: CFO, CFI and CFF. First item, furniture 30,000. Where should we put this? CFI, investing activity. So we will say minus 30. Then repay bank loan of 20,000. Where should we put this? CFF, financing activity. So minus 20,000 here. Sales 50. Should I write sales entire 15 CFO? No, the cash that we received is 45. So we will write 45,000 here. And salary 5,000. It should be a part of CFO, but a outflow. So minus 5,000. Let's take a total. So this would be 40. This would be minus 30. This would be minus 20. What is the total of all the three components? Minus 10. Is that matching with the amount by which cash flows have changed? Yes. So this cash flow statement is giving us insight that what happened with the cash this year. Through business we generated 40. We spent 30 on investments. We spent 20 on repaying our loans. In the cash flows, that remaining 5 will not come because we have not received the cash yet. If they pay us next year, so cash flow statement is all about cash. If there is a non-cash item, we don't worry about it. Any questions you want to ask here? So there are multiple types of questions that can be framed on this reading. But there is one peculiar type of question that can be solved with the help of flowcharts. So we'll start solving those type of questions now. So you would be given data like this. Opening inventory 10,000, closing inventory 20,000, COGS 15,000. Find out what is the total amount of purchase. So there is one really simple way of dealing with questions like these. So you'd build the first flowchart, which is on inventory. You'll build a flowchart like this. You will say opening inventory, which is the starting point. Now opening inventory will typically increase because of what? because of new purchase. So what you have to assume for these flowcharts, for ease of understanding purpose, that this purchase activity, the top portion of the flowchart, will happen for the first half of the year. So somewhere in the middle of the year, we will have total X amount of inventory with us, opening inventory plus purchase. Then we will start using this inventory. And what can we do with this? Either we can sell that inventory, and if you sell that inventory, it is considered as COGS, or it will remain in your closing stock. And the trick is that COGS plus closing stock should be equal to X, which should be equal to purchases plus opening inventory. So if you can find these two, you would know what is the total at the top. If you can find these two, then you know what is the total here. If you have any three components, you can always find out the fourth one. Are you following this? So let's fill in this flowchart. Opening inventory 10. So I'm writing 10,000 here. Purchase is what we need to find out. COGS 15,000. Closing inventory 20,000. The moment you have these two items, 15 plus 20, how much should be X? X should be 35,000. Which means the purchases is the balancing figure, which should be 25,000. Any questions here? Should we do next example? Opening accounts receivable 170,000. Closing accounts receivable 50,000. Sales made during the year 100,000. Credit sales are 50% of total sales. Find out cash received from accounts receivable. Cash received from accounts receivable. So again, we can build a simple flowchart. Please observe carefully. Starting point is opening accounts receivable. Opening accounts receivable will increase by what? Accounts receivable means you are supposed to receive money. It will increase by credit sales, not total sales, only the credit sales. So credit sales. So we have to assume that credit sales happened for the first half of the year. So somewhere in the middle of the year, we have this amount of X. Now there are two things which can happen with this. Either those people will come and pay us cash. So rather I should be saying received cash. Cash received. Or it will remain in the closing balance. So closing accounts receivable. So again there are four variables. If you have any three, you can find out the fourth one. Opening accounts receivable 170,000. Closing accounts receivable 50,000. Sales 100,000, but credit sales is how much? 50,000. So we have these two items. Immediately we can understand that amount of X has to be 220. If closing AR is 50, then cash received has to be the balancing figure, which is 170,000. Any questions? Third flowchart. Opening accounts payable. Opening accounts payable 190,000. Credit purchases made during the year 70,000. Closing accounts payable 120,000. Find out cash paid to AP. Cash paid to AP. So how is this flowchart built? Opening accounts payable which will increase by the amount of credit purchase. So credit purchase. So somewhere in the middle of the year we will have a total amount of X. There are two things that can happen. Either we can pay these people cash or they will still remain in the closing balance. Make sense? So opening accounts payable 190,000. Credit purchase 70,000. So we have top portion of this flowchart, which means X in this case has to be 260,000. Closing accounts payable is 120. So cash paid to accounts payable has to be 140. Let's integrate the three flowcharts together now. Opening inventory plus purchases COGS closing inventory. Opening accounts receivable plus credit sales cash received closing accounts receivable. Opening accounts payable credit purchases cash paid closing accounts payable. Now on the exam you might see an integrated question where all the data would be given, and the link is that you might first be required to prepare this flowchart, and using this flowchart you will find out what is the total purchase, and then you would be told that out of total purchase 70% is credit. So using that information you would find out what is the credit purchase, and then you might be required to solve for this particular item and this particular item. So how they are linked with each other, that some percentage of total purchase has to be credit purchase. Are you fine with this? Do you want to practice a question? Let's do an integrated question now. Sales 170,000. Opening inventory 50,000. Closing inventory 90,000. Gross profit margin 50%. Opening accounts payable 10,000. Closing accounts payable 135,000. Opening accounts receivable 60,000. Closing accounts receivable 90,000. 100% sales is credit. You have to find out four components. You have to find out number 1, cash purchase. Number 2, cash sales. Number 3, cash paid to AP accounts payable. And number 4, cash received from accounts receivable. Should we do this together now? 3 flowcharts. First we'll start with inventory. Inventory will increase by the amount of total purchase. So we have X. Either it would be a part of COGS or it would be closing stock. Accounts receivable will increase by the amount of credit sales. So we have X. Either we will receive cash or it would be closing stock. Accounts payable will increase by the amount of credit purchase. So we have X. Either we will pay cash or it would be in closing stock. On the exam, the biggest difficulty that people face is from where to start. So good strategy is build whatever flowcharts you think are relevant and start filling in the blanks. So sales 170, 100% sales is credit sales. So we have this data 170. Whatever information is there, I am just putting it into flowcharts. Opening inventory 50. Total purchases, we don't know that right now. Closing stock 90. COGS, your sales is 170. COGS gross profit margin is 50%. So therefore your COGS would be again remaining 50%, 85. So 85 plus 90, this X is 75. And therefore amount of purchases has to be 125. How many of you got this right? Great. Then accounts payable data, which is given here. Accounts payable is 10,000. We don't know the credit purchase for the timing. Closing accounts payable 135. We don't know cash paid. Opening accounts receivable 60. So we have 60. Closing is 90. Now because we have these two values, we can solve for X here. So this would be 230. And because this is 230, you can get your first number, which is 140. So we have completed the first two flowcharts. Now we are on to the last one. Last one, we don't have much of information. Opening accounts payable 10, closing accounts payable 135. Neither do we have credit purchase nor do we have cash. But logic that we can use is that since this is 135, from 10 to 135, minimum amount of credit purchase should be 125 and total credit purchase is 125. Are you following the logic? Which means entire amount of purchase has to be the credit purchase, otherwise your equation will never satisfy. Right? At minimum, your credit purchase cannot exceed total purchase. And to satisfy this equation, we will have to say entire 125 is credit purchase. Therefore, cash paid is 0. So now we have all the data. Have you understood this part? So step number 1, we were asked what is the cash sales. How much is cash sales? 0. Then what is the cash purchase? Cash purchase is 0 because entire purchase turned out to be credit purchase. Then step number 3, what is the cash received from accounts receivable? 140. And what is the cash paid to accounts payable? 0. So these 4 components will make up your CFO, and in this case CFO is positive 140,000. Account payable. I am repeating accounts payable part. Opening accounts payable 10. We already knew this. Closing accounts payable 135. So to satisfy this, minimum credit purchase has to be 125. Agree? What is the total purchase? 125. The rule of thumb, credit purchase cannot exceed total purchase, which is intuitive, which means entire 125 has to be credit purchase in this case. Then only your equation gets satisfied. Cash paid to accounts payable. That's cash AP. Are you fine?